All right, now we're going to be doing 21 through 30. So Alpha paid cash for 1 year of rent in the third month of the year, but recorded it as cash paid to satisfy an account payable. Alpha also failed to record the required adjusting journal entry for the rent used during the year. So there's a lot going on in this one. They recorded it as cash paid to satisfy an account payable, which is a debit to accounts payable and a credit to cash. This accounts payable lowered our liabilities by a lot, and this credit to cash lowered our assets a lot. What they should have been doing was a debit to prepaid rent, which would have increased our assets, and a credit to cash, which would have decreased our assets. They also did not record the expense of the months that we used. And since we had a few months left, we're not going to expense all of this prepaid rent. So I'm going to use 12,000 for the total and 10,000 for what we did use, what we should be expensing. You can use any numbers you want as long as the expense is lower. So they didn't record the amount that they used, which should have been a debit to rent expense for 10,000 and a credit to prepaid rent for 10,000. It's not prepaid rent anymore because we used it. So let's look at our assets. So this credit to cash was correct. So we don't really have to pay attention to this. Our assets should have been increased by 12, but decreased by 10. So net still should have been increased by 2,000. So our assets are going to be understated. Now for liabilities, they were decreased when they shouldn't have been in the first place. So liabilities are going to be understated. And this expense was never recorded, which would have decreased our net income. And our net income should be lower than what it is now, which means our net income is overstated. Number 22. Alpha recorded the credit purchase of supplies as a debit to supplies and a credit to cash. If it was a credit purchase, I don't think we should have credited cash, right? So they did a debit to supplies and a credit to cash when it should have been a debit to supplies and a credit to accounts payable. So the supplies debit was correct. So we can just pay attention to the cash and the accounts payable. Our assets were decreased by this cash when they should not have been. So our assets are going to be understated. Liabilities should have been increased, but they never were. So our liabilities are going to be understated. And none of these accounts affect our net income. So there's no effect on our net income. Number 23. Alpha made a cash sale, but recorded it as cash received from a customer as payment to satisfy an existing account receivable. So what they did a debit to cash and a credit to AR to satisfy this account receivable when it should have been a debit to cash and a credit to sales revenue. So this debit to cash was correct, so we can ignore that. The credit to AR did lower our assets, and this credit to sales revenue should have increased our net income. So now looking at the answer, we're going to ignore this. So AR was decreased when it shouldn't have been, which lowered our assets. And so our assets are going to be understated. None of these accounts affect our liabilities, so there's no effect on our liabilities. Sales revenue, though, which increases our net income, was never recorded. And our net income should have been increased, which means our net income is going to be understated. All right, number 24. Alpha failed to record the return of inventory to the vendor for cash, assume the use of periodic inventory system. So they returned inventory for cash. So they forgot to record this, which they should have done a debit to cash, which would have increased our assets, and a credit to purchase returns and allowances. And so if purchases are an expense and they lower our net income, then purchase returns and allowances, which is a contra account of our purchases, they're going to increase our net income back up. So this was never done. Our assets should have been increased. So our assets are going to be understated. None of these accounts affect our liabilities, so there's no effect on our liabilities. And this credit to purchase returns and allowances would have increased our net income, and this was never done, so our net income is going to be understated. Number 25. Alpha failed to record the following adjusting journal entry. The sales account includes a $5,000 payment received in advance from a customer. By year end, only $3,000 of the merchandise had been delivered to the customer. So when they're looking at the sales account, $5,000 is in it right now, but at the end of the year, only 3,000 of it has been earned. So what we need to do is we need to do an unusual adjusting journal entry to take out the 2,000 that has not been earned, should not be in the sales account. So we need to debit sales revenue for 2,000, and we need to put it into unearned revenue, credit unearned revenue for 2,000. Debit to sales revenue is going to decrease our net income, and the credit to unearned revenue is going to increase our liabilities. So neither of these accounts affect our assets, so there's going to be no effect on our assets. Liabilities were never increased, so our liabilities are going to be understated, and our net income was never decreased, so our net income is going to be overstated. All right, number 26. Alpha failed to record rent paid in advance to its landlord by year end. All but 1 month of the rent had been used. This omission includes the transaction and the adjusted journal entry. So here we have the transaction, which is a debit to prepaid rent for $12,000. We'll say it's $1,000 a month for 12 months. Prepaid rent would have increased our assets. Then we also should have done a credit to cash for $12,000, which would have decreased our assets. Now, all but 1 month has been used. So that means this is the adjusting journal entry. We have to expense the 11 months that we did use, which is going to be that 11,000, and that's going to lower our net income. And then we also have to credit our prepaid rent because it's not prepaid anymore. We already used it. And that's going to lower our assets. So now looking at our assets, should have been increased by 12, but decreased by 12. So those kind of cancel each other out. But it also, again, should have been decreased by 11. So assets are overstated. None of these accounts affect our liabilities, so it's going to be no effect on our liabilities. Net income should have been decreased by this rent expense. So expenses decrease our net income, so our net income is overstated. Number 27, failed to record adjusting journal entry. Salaries are paid every Friday for a 5-day work week. The normal payroll is 40,000. Year end falls on Tuesday. So we want to record the salaries expense for Monday and Tuesday, but we're not ready to pay the cash until Friday. So we're going to do something else with that. We're going to do an adjusting journal entry. And they forgot to do this. So they should have done a debit to salaries expense for 16,000, which is the 40,000 divided by 5 days a week, which is $8,000 a day, times 2 because it's Monday and Tuesday, which is 16,000. That's how I got that 16,000. Okay, so here they should have done a debit to salaries expense, which is going to lower our net income, and they should have done a credit to salaries payable, which is going to increase our liabilities. So neither of these accounts affect our assets, so it's going to be no effect on our assets. Salaries payable was credited, which is going to increase our liabilities, and that was never done. So our liabilities are understated. And our salaries expense, which lowers our net income, was never recorded. So our net income is going to be overstated. Number 28, failed to record adjusting journal entry. Examining the rent expense account, the controller finds that it includes $4,800 advance payment for 3 months rent. The payment was made on November 1st. So what they should have done was they expensed all of it on November 1st when they paid it. And now at the end of the year, on December 31st, only 2 months has been used. So they have to unexpense that 1 month that they didn't use. So they have to increase their prepaid rent because it was never increased in the first place. So it's going to be a debit to prepaid rent, which is going to increase our assets. And they have to unexpense, so they have to credit their rent expense. And by lowering that expense, unexpensing it, it's going to increase our net income back up. So the debit to prepaid rent, which increases our assets, is going to make assets understated because it was never increased. Nothing happens to our liabilities because neither of these accounts affect our liabilities. And this unexpense, the rent expense was never done, which is going to increase our net income. And that was never done. So net income is going to be understated. All right. Number 29, failed to record adjusting journal entry. There's $500 of office supplies left in the storeroom. At the beginning of the year, there were no office supplies. During the year, 3,500 of the supplies was purchased. So beginning, they had nothing. During the year, they had 3,500 that they bought. Then at the end of the year, they only had 500 left. So they have to do an adjusting journal entry for what they used during the year. That's going to be a debit to supplies expense for 3,000, which is going to lower our net income. And they're going to credit supplies for what they use. They shouldn't have that in their supplies account anymore, which is going to decrease our assets. So this was never done. So for assets, they should have been decreased. So our assets are going to be overstated. Neither of these accounts affect our liabilities. So there's no effect on our liabilities. And this expense was never recorded, which would have lowered our net income. So our net income is overstated. Number 30. So failed to record adjusting journal entry. Alpha received an order in May with a $13,000 advance payment, which was credited to unearned revenue. In November, the last of the order was shipped to the customer. So when they got the 13,000, they put all of it into unearned revenue. But at the end of the year, they shipped it. So, or in November, they shipped it, which means it's now been earned. So they have to take it out of unearned revenue and put it into revenue. So it should have been a debit to unearned and a credit to service revenue. The debit to unearned revenue is going to lower that liability because we don't have it anymore. We've now earned it. And the credit to service revenue is going to increase our net income. So neither of these accounts affect our assets, so there's no effect on our assets. Liabilities should have been decreased, but they hadn't been yet. So our liabilities are overstated and our net income was never increased. So our net income is understated. And that is 21 through 30.